and welcome to the investment review for August, looking back at the events of last month. To give some thought to an economic commentary, the unprecedented boom of the emerging markets that has supported global growth figures over the past decade appears to be coming to its close. Growth in the emerging markets has helped boost the world economy overall by making up for the weaknesses in the richer countries during the financial crisis. The general slowdown is resulting in IMF projections of global growth at about 3% in 2013, the same as in 2012, and just below 4% for 2014. Looking forward, therefore, investment growth will continue, but in all probability at a more modest rate than previously. In the pre-crisis economics models, growth and job creation were powered by consumer spending. It will be necessary for the major nations to look inwards for a self-sustaining economic recovery rather than relying on other countries in a similar position to themselves to import their goods. In order to stimulate growth, the major nations therefore need to increase their own domestic consumption and encourage consumer spending, if necessary, financed by debt. Interesting and once again unprecedented times therefore face us as the major nations rebalance their economies. Thinking a little more about emerging markets, the graph on the next slide demonstrates the context of the comment above, showing the position over the past 10 years where the emerging markets have steamed ahead of the developed markets in terms of growth. The red line on this chart reflects the growth in the emerging markets, whilst the green line below it is a more generic representation of world growth. To give some consideration to market performance, if we take a look at the graph on the next slide, you will see the ride that markets have had over the past 6 months. During this time you may have noted a fall in your investment value in mid to late May. Markets are now enjoying something of a recovery since they reached a low point before the end of June, which will be reflected in your valuations now. You will see, however, that the earlier comment about the slowdown in emerging markets growth are reflected over this short period. So in contrast, the green line here is a generic world growth performance representation, whilst the red line is the emerging markets on a generic basis also. And you'll see that when we analyse this over a shorter term, the emerging market funds have been under a little more pressure. In summary, what this continues to demonstrate is that markets will continue to rise and fall, and obviously with them the value of our investments. In seeking out investment returns to improve on cash, which is in itself guaranteed to lose value in real terms, and most recently premium bonds, where the overall prize money has been reduced to a yield of just 1.3%, it is now for the first time necessary to take some investment risk. I do have every confidence that remaining invested in a diverse portfolio of actively managed funds will give each of us access to returns in excess of cash over the longer term. Obviously, we carefully research our investment funds to enable you to benefit from the expertise of fund managers and their teams who actively research and select the assets held within each of those funds. We continue to monitor the markets on a daily basis and will inform you if we believe there need to be any significant changes to your investments. As always, you are welcome to call us to discuss your individual investments should you have any concerns at all. All of our contact details appear on the last slide.